The prescribed asset sabre is being rattled again. Every now and again it seems to enter the public discourse in South Africa. This time around it was chairman of the ANC in Gauteng, Paul Mashatile, saying that the party would table proposals in this regard at its National General Council in October. He was addressing the JSE during a discussion on shareholder activism to promote economic transformation. Of course, this is also reflected in Economic Planning Minister Ibrahim Patel's new growth path, which hints that the pool of past savings in government pension funds may be another source of funding for government's ambitious development plans. And yesterday, Sean Hagedorn, an independent strategist, was published in the Business Day saying that if correctly structured, this could be an option, but considering the country's fundamental political challenges, prescribed assets are generally a bad idea. I thought pretty limp-wristed stuff. To talk about prescribed assets, I'm joined now by Andrew Canter, Futuregrowth CIO. Andrew, welcome to the Classic Business Sustainability feature.
Thanks for having me.
The idea behind prescribed assets harks back to a really bygone era, doesn't it? During Ian Smith's time, it was a law that pension funds and pooled funds had to invest a portion under management in prescribed assets, and so too under apartheid in the 60s, 70s and 80s. What do you make of the idea?
I think it's a disastrous idea. I think that people's pension funds are discretionary savings that are not intended and are not instruments of state policy. If the state, as it should be a developmental state, wishes to promote development in the country, they have to do it within the framework of a savings and investment environment, and that's the system we operate under. You start messing with people's pension funds, you will reduce the savings rate, and that'll net hurt the competitiveness of the economy in the global environment. Now,
and I want to hark back to the days when it was used. I mean, the problem with Ian Smith and the apartheid government's options is that they served as an example of exactly what can go wrong with this option. The bulk of the funds that were raised were dedicated to projects that served a very thin racial minority and a politically expedient grouping. So what's to allay the fears that this won't be repeated and that the funds will serve a politically expedient group majority today?
Well, I can't speak so much for Rhodesia, but my impression is that South Africa at the time, in the 80s in particular, wasn't able to fund in the global capital markets. It couldn't. The capital markets domestically weren't as efficient. They had to use prescription as a instrument in order to force investment money into the government's own initiatives. But the world is vastly different now.
When one looks at the idea, I mean, it comes against the backdrop of the ANC-led government running out of fiscal runway, and many fearing that this policy option will be used to prop up some of the failed social spending projects and policies. Isn't there a way that this could be countered by ensuring that prescribed assets are only invested in long-term kind of infrastructure, gross fixed capital formation type projects?
Well, but we have a mechanism to do that already. It's called the capital market. If a project is appropriately put together, appropriately managed, and with an appropriate business plan and a revenue stream, you can fund it in the public capital markets. It is a great advantage of South Africa that our debt capital market, for example, is probably amongst one of the best in the world. We have 30-year yield curves, actively traded government bonds. There's a corporate debt market that's fairly robust. We didn't suffer in the financial crisis from some of the excesses of what happened internationally. It is an asset. I mean, cost of capital is one of the key inputs to the growth of an economy, and South Africa already has a competitive position. Now, to try and bypass that because the government is running out of fiscal runway is basically saying the government is spending more than it's taking in. That you don't solve that by raiding people's pension funds. And let's be frank. What is going on here is a desire to use people's pension funds for subsidized capital, not free market rate setting capital, which is what we do. Of course, what investors do is set rates for risk, but actually try and get subsidy capital. That is simply not the role of pension funds. And if I tell you your pension fund is going to be seized by the state as subsidy capital, what are you going to do?
Well,
you're going to stop saving, right?
Exactly.
And that's a disaster. You're going to have a lot of people who stop saving when what we're trying to do is encourage people to do the opposite, to save for retirement. So we create a better savings pool and a better safety net for people's long-term well-being.
And that runs counter to the retirement reforms currently on the table,
Absolutely.
talk of preservation and all the rest of it. So a bit of the left hand not knowing what the other left hand is doing in terms of policy. Just finally, before I let you go, Andrew, we look at the state of our infrastructure spending at the moment, and it's often bemoaned by chief executives on this program that it's just not getting out of first gear. What do you see as the big key to unlocking this grand infrastructure tsunami that we're waiting for?
So I want to make 2 points. In my experience, we've been doing developmental investing since the mid-1990s. There's rarely been a time, if ever was there a time, when we didn't have enough money in the pension fund market or in the private sector to fund well-structured, well-put-together, appropriate transactions, whether it's large scale or small scale. Look at the probably 120 to 130 billion rand that's been channeled into the alternative energy sector through dozens of deals in the past 3 years. It's an extraordinary success. It just shows that a well-put-together program with government support, not subsidy, but support and intent and running a fair level playing field can mobilize huge amounts of capital. There is really no constraint on the funding required by Transnet, by the water boards, by Eskom, by the power industry, et cetera, in this country. There really is no shortage of money. And I'd like to make one more point about prescription. If the government feels so strongly that it needs to tap pension funds to fund the long-term infrastructure needs, the government itself controls enormous pension funds. I mean, the government's employees' pension fund is a defined benefit scheme. It isn't taking from the private sector. It's off the fiscus anyway. If they want to do that, they own Eskom. They own a variety of state-owned entities. They could tap those pension funds, which, by the way, are probably in aggregate, I'm going to make up a number, between 1.5 and 2 trillion rand. They do not need to raid the private sector piggy bank.
That was Andrew Canter, Chief Investment Officer of Futuregrowth, sharing his frank views on the prescribed assets debates here on Classic Business. Coming up next, we're going to see whether the office of the future is all drones and holograms or far more humane. Stay tuned.